Whether it's learning about earnings estimates, exploring the Zacks Rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. Now we're going to talk about shorting stocks, but not just any stocks, certain stocks in particular. So for that, we're going to call on Steve Reitmeister, our editor-at-large, to fill in all the blanks and give us all the detail. Let me tell you, we often talk here about the benefits of buying Zacks #1 ranked stocks and their 27% annual return since 1988. But there's an interesting question that keeps popping up from our customers and viewers, and that is it a profitable strategy to short the Zacks #5 ranked stocks, the strong sell stocks?
Right. Yeah, I understand why that question's coming up, especially in this dicey environment right now, but I wish there was a straightforward answer. I'm reminded of a song on one of my daughter's children's CDs, and the song goes, yes, no, maybe so.
You listen to those too?
Yeah, unfortunately. I can sing a lot of Barney songs still from when they used to play them. So this one just stuck in my mind, and it's the perfect answer for this one. Sometimes it works brilliantly. Other times it doesn't work at all, and sometimes maybe so, depending on the environment. So we'll cover each of the three different scenarios, and hopefully by the end it will make more sense than my initial answer. But we're going to save the yes, the one that seems to consistently work, to the end, because always trying to save the best till the end.
Fair enough. Let's start the journey then with why it is not a good strategy maybe to short those #5 ranked stocks.
Yeah, I'm going to put up a couple slides here really quick, and the first reason is because this is the annual return for the Zacks #5 ranked stocks. Okay. It is in the negative category, but you can see it's less than 0.1% to the negative side in terms of an annual return since 1988. That is not negative enough as a group to make it worthwhile with transaction costs and things of that nature. So in other words, it's not like they always tumble and it's they're great stocks to short no matter the environment, because here again, the average return is, let's just call it 0, and with transaction costs that doesn't make it fertile ground. The second reason is because as a group, the #5s have been profitable, as a collection of stocks 13 out of 21 years. So pretty much 2/3 of the time, they've been profitable as a group, so in general the environment is not ripe for them to be shorted and just assume, oh, we'll make profits on that strategy.
So in general, okay, it doesn't work, and certainly not a recipe for instant success, to say the least. But share with us the maybe so part that you were talking about. Yeah,
the maybe so depends on the environment. So in 2008, the market falls 37% and continues to fall this year. And the #5s have fallen a lot more. So last year the market fell 37%, and the #5 ranked stocks, the strong sells, fell by 51%. So yeah, you would have made a lot of money shorting that stock as a group. But here, as I was showing before, that's not always the case. So in the right environment, the maybe so environment, if it is negative, this is definitely the group of stocks to look at. They are the weakest performers. They are the group most likely to tumble the most. And so in that negative environment, yes, that is the group I would look at to short stocks, but it doesn't work like that all the time.
All right, and you said it yourself, you want to save the best for last, so I wish I had that drum roll. Yeah. So what is the shorting strategy for the #5 ranked stocks that seems to work fairly consistently?
Yeah, it's what we call a market neutral approach, or some might call it a hedged portfolio. The idea is that you go long, you buy the best stocks, and then you short the worst stocks, and you try and make a profit on the difference. So obviously, using the Zacks Rank, if you bought the best stocks, Zacks Ranks 1s and 2s, and you shorted 4s and 5s, you're trying to create money on the difference. So even in a negative environment, let's say like over the past year here, let's say that the #1s fell by 20%, and the number 4s and 5s fell by 30 or 40%. Okay. You would make about a 10-20% profit on the spread in between the two. So even when both groups are falling, but because one group's doing better than the other, okay, you make a profit on the difference. Now, this is not a strategy for the faint of heart. It's not for the novice investor, which is a little more for sophisticated investors. And that's why I want to point out that we do have a mutual fund that I'll put the symbol up on the board here, the Zacks Market Neutral Fund, where the managers at Zacks Investment Management that are professionals, they do the work, they construct the portfolio, and it's traded as a publicly available mutual fund, that they will do this strategy for you. And so for people who are a little more in wealth preservation mode, this is a nice, safe strategy that has held up a lot better than the market, and the intention is to beat the not to beat the market, but to provide a constant return or positive return no matter if the market's up or down. So I'd recommend if people are interested in that kind of strategy, they take a look at the mutual fund.
All right, and as always, we appreciate the insights from you. And that is just another little tool that you can throw in your arsenal of tools when you're considering investing the Zacks way. I'm Terry Ruffalo.